Those people who've watched our channel regularly know that I've done a piece on convertible bonds, or CoCo bonds, and I wanted to update that piece today because something that's coming out of China is actually quite interesting to me. So it seems that in the first week of October, the Bank of China sold $6.5 billion worth of CoCo bonds. And by the end of the year, the four biggest banks in China are planning on selling $20 billion of CoCo bonds. So a CoCo bond is basically, think of the following idea. A company has bonds outstanding that it pays a 4% interest rate on. A CoCo bond gives you a slightly higher interest rate, but in case the company that issues the bond gets into a little bit of trouble, the bond instantly gets converted into equity, and so they don't have to pay any more interest on it, and you just become another common shareholder. That's the idea behind a CoCo bond, and that's what the four big banks in China are just about to sell $20 billion of. So if you need to understand the logic behind what a CoCo bond investor is doing, think of the following idea. Right now the Bank of China offers bonds at say 4%. And they're offering their CoCo bonds at 6.5%. And so those people who are buying CoCo bonds, $6.5 billion of them in the first week of October, are saying to themselves, okay, I'm not going to buy a regular bond with all the protections that that bond offers. I'm going to pay, but the same price, but I'm going to get another 2.5% interest from it. The problem is, from my perspective, that in order to get that 2.5% interest, they're exposing themselves to massive, massive risks. So the insiders, the people who know more than you do, are selling you these collateralized bonds at a time when they know they're going to head into stormy waters, and the probability of you getting converted from your CoCo bond into equity is very, very high, or at least high enough that you're not adequately compensated with the extra 2.5% interest. So you're getting an extra 2.5% interest, but you're risking a massive loss of capital in so doing. Now the reason they're doing this is they need to bolster their capital structure in order to compensate for the bad debts that are growing in China as the Chinese economy slows. That, coupled with the fact that the Chinese government itself is actually becoming much more strict in imposing the rules of a bank regulatory regime called Basel III. We don't need to talk about that at the moment, but basically the idea is that the Chinese government's getting a little bit more strict with its banks, not letting them play fast and loose with their capital controls and everything else. And so the bankers in China realize that the writing is on the wall, that their economy is starting to slow, so they're selling off a lot of convertible bonds, or CoCo bonds, and in so doing, I think they're going to shear a lot of investors. And so that's why I think CoCo bonds are a problem. I think the CoCo bonds that are coming out of China right now are a harbinger of bad things that we're going to see in China in 2015 and 2016 as their economy slows and as bad debts rise. For you geeks out there, I think CoCo bonds are similar in one way and one way only to a valuation allowance in the following way. When they rise, when you see a company throwing valuation allowances on its financial statements, or when you see CoCo bonds getting issued, you know that's a sign that there's trouble up-ruin. There's going to be bad things happening to that issuing company in the next year, 18 months, 2 years, and so on. So CoCo bonds coming out of China at the moment, I think, are harbingers of rising bad debts in China and slowing Chinese economy. Not news certainly, but watch out for these CoCo bonds in 2015, 2016. Thank you very much. Next time we're going to be talking about gold and why I've determined pretty definitively it's a silly investment. I hope you look forward to that. Thank you very much, and as usual I look forward to comments and questions.